Hey, welcome back to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, CEO of the 501c3 nonprofit, nonpartisan Frank Laduce Foundation. Everyday Economics is a production of America's Talking Network. You can subscribe to all of our podcasts at americastalking.com. To support Everyday Economics, please make a tax-deductible charitable contribution, clicking the link in the show description. We are recording this episode on Friday, August 9th, and joining me as always, my friend and colleague, Dr. Orphe Divounguy. He is a PhD economist. Dr. O, when we got together last week, I think if I had any hair to pull out, I would have pulled it out. The stock market was really suffering, and it looked like there was no bottom. There were a lot of people that were panicking. People were saying, "Oh, the recession is here. The recession is here," and yes, there was madness basically in the market. And you said, "No, relax. This is but a blip." And we've actually, this week, we've had a fairly reasonable recovery. I mean, we didn't go all the way back to where we were, but either on the Dow or the NASDAQ. So are you ready to take a victory lap here?
Yeah, let's do a dance. Of course. Look,
you would make a great wedding date. I think is basically the bottom line here. Yeah, all right. So go ahead, take your lap. What did you get right? And how right were you?
Look, bottom line is everybody started panicking, right? Recession fears, because we had one jobs report that showed employment growth had slowed.
Yeah.
And showed the unemployment rate has increased. But I've been telling
and
people,
that the vast majority of those jobs were government jobs in one way, shape, or form. If I could just add that, kind of just slip that in there.
Sure. Government jobs, but also construction employment up, which, by the way, tells you what? Wage growth for builders is the highest it's been in a long time.
Yeah.
There's a lot of demand for housing. So builders are out there building stuff, and they need to hire workers.
Uh-huh.
And so, right? And so if demand outpaces supply, wage growth for builders is much higher than it's been in the past. And that's exactly what we're seeing. Consumer spending up 2.6%, right? Consumers are still out there really supporting this economy.
I'm somewhat worried about that because we haven't checked in on consumer debt recently.
Totally.
And we haven't talked about savings recently.
It's rising, but it's rising at a more sustainable pace. Here's why. Inflation is lower. Our miracle Fed helped us bring inflation down from 9% in June of 2022 down to just 3% in June of 2024, just 2 years. Unbelievable. Inflation is lower. Price growth is easing faster than wage growth, and real wages adjusted for inflation are higher, not lower. It's amazing. The employment rate of prime working age individuals, ages 25 to 54, is the highest it's been in 23 years. I mean, look, the economy is slowing, but it's not crashing. It's nowhere near crashing. It's slowing from an unsustainably hot pace that we had during the pandemic. And
you love going after the doom prophets, because I mean, you know,
do.
like the people that do that kind of like sort of, cardiac arrest approach to economic news. I mean, eventually they're going to get it right, and they're going to be like, "Look, I nailed that."
Yeah.
But,
eventually. But as of right now, productivity growth is rising. Employment is super high and remaining high. The surge in the unemployment rate. First thing is big increase in labor supply. I think America's labor force has been growing due to immigration, partly. And as people go into the labor force, right, some of them will find a job, and others will stay unemployed for a little bit longer, especially right now because hiring rates have fallen. And that's going to contribute to raising the unemployment rate. And so but permanent layoffs remain very low. Right. So, I mean, it's a labor market that's cooling, but not crashing. And ultimately, look, the Federal Reserve Bank, the Federal Reserve Board is going to look at that and say, oh yeah, inflation is now 3%. The Fed funds rate is still 5.25, between 5.25, 5.5%.
Mm-hmm.
That's not appropriate. They're going to lower the Fed funds rate, and to move policy from less, more restrictive to less restrictive and somewhat neutral. And you're going to see that, and that's in September, hopefully, fingers crossed. I think it's going to happen. And what that does is it actually helps prolong the economic expansion.
Mm-hmm.
And so the doom's prophets, the charlatans of gloom and prophets of doom, wrong again, and probably will be wrong if they call for recession before the end of 2024. And I think we're in a much better place going into 2025 than we were even just a year ago.
How do you feel about the September Fed update? And do you think we're going to see that cut in September? I mean, there's a lot of eyes on the Fed, obviously, right now. I mean, we're in the backstretch of what has been an absolutely crazy presidential election cycle, right? I mean, it's been absolutely crazy. I mean, I think people have sort of moved on from the fact that less than a month ago, the candidate for president, the Republican candidate for president, was nearly assassinated. President Biden, basically, who had said for years, I'm in. I mean, literally 2 years, he'd said, "Yeah, I'm absolutely running again," and his mental capacities were validated by dozens of people who either have influence or are specifically in the media. And then he steps out, and then Kamala Harris steps in, basically, just seizes this opportunity. Now she's picked a running mate. There's a lot of stuff that's going on right now. And in the backdrop of all that, would be, this economic reality that we're processing right now, trying to have a conversation around. I mean, what do you anticipate happening? I mean, it's because there is, not to say political chaos, because there isn't. I mean, I think if you pay attention, you've seen a lot of these things coming, right? But this is a strange time, and economic decisions at this time will be consequential.
Yes and no. I mean,
Well, give it back to me. If you don't agree with that, I mean, obviously, we're not here to just agree.
Decisions in Congress won't be extremely consequential.
Yeah.
The Fed doesn't care who's running for president and who's not. The Fed cares about bringing inflation down to the 2% target.
Right.
And keeping Americans employed and making sure the financial systems and banking system is running, is well functioning. And so in September, I expect a Fed rate cut. Look, the markets were pricing a 75 basis point, a 50 basis point rate cut, as of just a couple of days ago.
Mm-hmm.
That's down to just a toss-up.
Quarter. Yeah, toss-up or a quarter, right?
A toss-up between 50 basis points and a quarter now.
Yeah.
Right? So it's kind of walked back the recession fears and right? And so bond yields, treasury yields have gone up a little bit. Mortgage rates have moved back up in the last couple of days. Right? It was exaggerated. The recession fears were exaggerated. Look, it's true the economy is slowing. It's true there are risks, but the Fed can actually address those risks by cutting interest rates in September. And I think that's probably what we're going to see. We're probably going to see a 25 basis point rate cut, not a 50 basis point rate cut. At least that's what I think is going to happen.
Mm-hmm.
It's going to be a slow and steady adjustment to neutral. And so, when the market had three cuts penciled in just a month or two ago, it was probably right. we're probably going to get 2 to 3 rate cuts by December. But yeah, the first rate cut, I think most economists agree that it should and would happen in September, because I don't think it's appropriate to have the Fed funds rate at 5.5% when inflation is just 3%.
Right.
So that policy has gotten too restrictive, and it showed up a little bit in hiring rates in the jobs report last week, which had everybody panic. A lot of people thought that by not cutting last month, the Fed had made a huge mistake, right? That it was an error on the Fed's part. Was it last month or just a week ago? I mean, geez, things are going so fast.
Well, I mean, we're not, I think that was at the end of July, the beginning of August. And
when was the last interest rate decision? I mean, it's so much has happened, like you said, in such a short period of time. I'm losing track here.
Yeah.
But yeah, I don't think the Fed made a mistake. I think the Fed is, and by the way, not a gut feeling like former President Trump said. It's not about a gut feeling. In fact, if you look at this Fed, they tend to they're very data dependent. Very data dependent.
They should be.
Well, I mean, to some extent, you would want them to anticipate where the economy is headed, rather than to wait for it for the latest data to come in and perhaps be a little bit too late to the party, right? But this Fed in particular has been very data dependent. They said they would be. They've stuck to that, and so it's not really. I don't think that was fair. This whole comment about a gut feeling. Former President Trump said gut feeling. No, it's not about a gut feeling. This Fed has been watching the numbers very carefully. And in fact, it's been criticized for acting too late because it was waiting for the numbers. So anyway, I think that's what I see. I see potentially a rate cut in September. Not as much as the markets had anticipated, maybe just 25 basis points.
Okay. All right. Well, I appreciate your thoughts, and we'll check in with you on that, of course. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other high-quality podcasts at americastalking.com.